You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network. I'm pleased to be joined on the show now by an old friend of the network, Mr. Blue Putnam, the senior economist over there at CME Group. Blue, welcome back to the Options Insider Radio program.
Oh, thank you, Mark. It's great to be here.
We have to stop meeting in these cold and dreary climates. This is just terrible.
It certainly is.
Yeah, listeners, we are recording this live to tape, at least, down here at the FIA Boca Conference. So a little bit of a nice change from the, shall we say, chillier weather we've been experiencing up there in Chicago. But Blue, you just got off the stage. You're hot and heavy right into our conversation here, delivering an interesting address about a variety of things, including a lot of FX. So maybe let's start there for our listeners who couldn't make it down here to Boca. Give us a little bit of an overview of what you talked about and why focus on FX for this event.
Well, you know, foreign exchange is just a great lens in which to view what's going on in the world because you're comparing one versus the other. Everything influences each other thing. So it's a really nice way to frame a good analysis of what's happening in world markets. So one of the things we talked about was the U.S. dollar and its leadership role in the currency markets and whether that's waning or not. Because like when I do currency analysis, there are really three things that happens. It's all relative, but the relatives that matter, well, not Uncle Bill, but you know, the other relatives.
That's economist humor. I like it. That's good.
You know, we have growth, economic growth. If you're growing really well, you're going to attract capital, your currency is going to be stronger. If you have high interest rates or your interest rates are rising, now either that's because you're going to attract capital or you got a lot of risks and you got to compensate for the risk, but still the interest rate really matters. And then you've got the risk. Is it going up or is it going down? If you look at the United States, the economy is definitely slowing down. Interest rates are on hold. The Fed, you know, after the fourth quarter said, nope, not doing anything in 2019. And the risks with the U.S. are clearly rising with the China trade war. Now, we might get a deal, we might not, but at least for now, you know, we got a higher, riskier situation for the U.S. So that would argue against the U.S. dollar. But then, of course, you have to figure out what are you trading against. And so you go to Europe. Oh, no, they're not growing at all. Their interest rates are zero, and they got tons of Brexit risk. So I'm sorry, that doesn't work. Let's go to the U.K. Oh, well, you know, they're hardly growing. Nothing going on in interest rates, and they really got Brexit risk, so that doesn't work. You go to Japan, they're not growing, zero interest rate. Anyway, if you look around the major currencies, there's just nothing, there's not a compelling case of one versus the other. I mean, the U.S. was a compelling case when it was growing faster than everybody else and raising rates, but that's not happening this year. So what are you going to do? Well, we think you're going to go on a tour of the world and look for currencies with higher interest rates, because that gives you, like if you take a look at Mexico or Brazil, if the currency is stable against the U.S. dollar or against whichever currency you trade it against, then you're going to make money because the interest rate pays you. The only problem with these trades, and by the way, they're called the FX carry trade, is that they generally come with a little extra risk. I mean, there's a reason why those interest rates are higher, and it's because risk. And it turns out right now it's almost all political risk. If you look at Mexico and Brazil, Mexico has like 6.5% interest rates, Brazil more like 8%. And so that's a nice return if the currency remains stable, but they both have new presidents that promised a lot, and they're having a little trouble getting started, and so those risks are still pretty large. Now, if you really want risk, you could go like Argentina. They have an election coming up in October 2019, and that's a pretty critical one. If Macri can win another term, then you're going to get paid. Interest rates in Argentina, by the way, are 55%. So, I mean, you make a lot even just overnight. Only, of course, if the currency doesn't go down. So you need some good things to happen to the Macri campaign. Then you go to India. India's a fast-growing country, lots of potential, and they got elections. And Modi is, we think he'll win, but it's a lot tighter this year. He was slipping in the polls. The recent troubles with Pakistan, he got a little lift. And this is an interesting election. 900 million people vote. There are 1 million polling places.
We can't even fathom those numbers in the U.S.
It occurs over a 5-week period. It's not just on one day. So, but they count the ballots on one day, and that's May 23rd, and then we'll know who won. So, if you want to go to some of these other currencies where you can get a nice interest rate, you're going to have to come to grips with the political risk, either a newly elected president or an election coming up. So it's a pretty mixed bag out there of hard things to figure out. So that takes me to China. And China's all about the trade war with the U.S. China's been hurt pretty bad. Their economy's definitely hurting, but the U.S. has been hurt bad too. Much worse than the U.S. thought it was going to be. And so both sides want a deal, but my read is, despite what the press out of Washington says they're close to a deal, but my read is they're still pretty far apart. So we'll see how that goes. But a lot of things going on in the currency world.
Yeah, you picked an auspicious day to be talking about currencies, Blue. Maybe you planned it this way with the Brexit vote, but of course the news coming out of England that it sounds like yet another defeat for Miss May. What are your thoughts on all that's unfolding and its impact on, particularly for the euro and for the pound?
Well, I think a lot of people analyze Brexit in terms of what's the deal? Is it good for the UK? Does it work for the EU? They're analyzing the deal. I understand that. It's just not the way that it's working out. The issue in the UK is who's going to lead the UK in the 2020s. Prime Minister May is trying to keep her job. And interestingly enough, she has this plan that she negotiated. Nobody likes it. But nobody wants her job because they know if they negotiated the same deal, no, they'd like that either. So she's done a great job of staying in power and stretching this thing out. So they had a vote. They didn't take her deal. And then they're going to vote whether they want a deal or no deal. And then they're going to vote as to whether they want an extension. And hello, they're going to want to kick the can down the road. I mean, what else do they do? So it's going to be pretty interesting there, but this is a saga that's going to keep on going on. And it's really about, from the point of view of UK politics, it's about who's going to lead the country in the next decade. And it's not so much about Brexit.
It does seem that the choice when given to bureaucrats is to punt whenever possible. And,
whenever possible.
Let the next guy have to deal with this. Well, you mentioned before the trade war. Obviously, that's top of mind for a lot of people out there. And now, we've been hearing rumors for a while that we're close to a deal, then we're farther apart, then we're close to a deal, then we're farther apart. Sounds like you're on the latter portion, the farther apart end of that curve. Why are you less optimistic that a trade deal is going to be developed?
To me, there are two parts to any deal. Did you have a deal, any deal, and then did it involve removing the tariffs? As far as I'm concerned, if the U.S. and China cut a deal and the tariffs aren't all removed, permanently removed, the markets aren't going to like it. Because it's not the trade war that's causing the problem, it's the tariffs. I mean, if you think about it, the U.S. put on the steel and aluminum tariffs last year. That couldn't have hit the automobile industry at a worse time. They're really in trouble. Now they're in more trouble. The Chinese retaliated with not buying soybeans. That really killed the U.S. farmer. So it's all about the tit-for-tat tariff war. And it's not clear that a deal removes the tariffs. So we could get a deal where both sides declare victory, but the tariffs stay, or they stay as a threat or something. And I don't think the markets, particularly the equity markets, I don't think they're going to like that tariff uncertainty.
No, definitely.
So we could get a deal, and it surprised people that it doesn't help equities as much as they thought.
It has been kind of interesting taking the pulse. I haven't been at the conference too long, but taking the pulse of the global audience at this conference and how they weigh in on the trade war. Will it happen? Will the deal happen or not? It's interesting to see what different people's views are. Speaking of different views, I just came from a briefing a little while ago today where they were talking about rates overseas, rates domestically, and they were talking about how one of the speakers in particular was predicting, and this is something I know you've been on this tip for a while too, that the Fed's not going to hike rates. I think that's not the recent data coming out of Europe and the U.S. certainly has probably given a little bit more steam to not raising rates anytime soon. But this one person in particular was talking about, he was thinking we might be heading towards another cycle like what we saw the last decade of effectively low rates for the better part of a decade. That struck me as a little interesting. I'm curious. I know you follow the rates cycle very well. I know you've been speaking out for a while that you don't think the Fed's going to make any changes in the near future. Another decade cycle of low rates, you think that could potentially be in store for us, Blue, or is that maybe a little bit pessimistic on the rate side?
No, that's a viable viewpoint. Because here's the issue. Since 1994, U.S. core inflation has been basically 2%. It's gotten up to 3, went back down to 1, but it's just a random number generator around 2%. And that's where we are today. Now, over that 25 years, the Fed tightened up the ease, they tightened up the ease. We had a tech rally in the stock market, we had a crash. We had a housing rally, we had a spectacular crash. We've had unemployment go up and down twice. I mean, the thing is that we are in an aging society with global competition, with a lot of technological change going on, and we don't have any inflation. And the Fed can no longer cause it. And the Bank of Japan can't cause it. And the European Central Bank can't cause inflation. And this is really hard for a central banker. You know, they thought they were the master of the universe, and it turns out they can't cause inflation anymore. I mean, the only viable way to cause inflation now is to be a relatively small country and kill your currency. So if your currency depreciates 50%, you're going to have inflation. But for a big country, US, Japan, Europe, the momentum of pretty stable prices with an aging economy and stable but slow growth suggests that there's almost nothing the Fed can do. Zero interest rates didn't work. Quantitative easing didn't work. I mean, they have to get used to the fact that they cannot push inflation. And when they get used to that, we might have a decade of low rates. A
decade. You just broke the hearts of all the brokers out there who are hoping for a return of their margin business.
Low rates doesn't mean they're not going to move. You know, they'll be low, and then they'll try to push them higher, and then they'll cut them, and then they'll push them higher. So there'll be plenty to trade.
There'll still be some volatility in the rate cycle.
There'll definitely be plenty of volatility, but since the 1982, every peak in rates has been lower than the one before. And I think, we're looking at that happening again.
You mentioned the easing earlier. We just heard talk last week out of Europe of stimulus again. Here we are in the U.S. talking about should we pump the brakes or not, and the rest of the world is talking about stimulus. It's a kind of a strange dichotomy we find ourselves in now. What were your thoughts on the remarks we saw coming out of Draghi and his crew over there last week?
I think as central bankers come to understand the limits of their power, they're actually going to be a very viable discussion about the role of fiscal policy. And, as an economist, I'm not all that excited about piling up the national debt. But if you have an economy that's not performing as well as it possibly should, then government spending may be more helpful to getting the economy to perform than zero rates. I mean, zero rates didn't work. So I think we're going to have a big argument about the relative role of monetary policy versus fiscal policy. And by the way, it's only government spending in my models that works. Tax cuts increase the debt, but they don't get money moving in the economy the same way. Whereas if you actually spend it, it's going to happen. Now, having said all that, I'm not for that. I just think that's where the debate is going to be. It's going to be a fiscal versus monetary policy debate that many countries have.
We started off talking about FX before we move off those remarks. I noticed the paper came out from your colleague, Eric, another one of our friends on the network here, Eric Norland, talking about skew and a variety of different products out there. I think including the yen and a variety of other products. And the efficacy, because that's something you talk about a lot on our shows, the efficacy of skew as a predictor, as some sort of determinant for the future of the currency. Have you had a chance to check out his paper, and what are your thoughts on his findings?
Yeah, I mean, one of the things that Eric does a great job on is looking at the options, not just the at-the-money options, but where they're trading a little out the maturity curve, where they're trading a little out the strike prices, out of the money, in the money. And there's a lot of information in how those trades, they tell you, what people are more worried about. And if you look at the volume as well, not just the skew, but the volume of people trading more puts than calls or vice versa, you get a more robust view of what markets are doing and where the fears are. Now, all of those markets, there's a buyer and a seller for every trade. So just because it's skewed one way or the other doesn't mean something's going to happen. What it does mean is that people are more worried about that part of the curve. Whether it's and when we're talking the skew, you're talking out of the money if something big could happen. And with all the political risk we have, that's become much more important, because with political risk, you generally have two scenarios. We get a trade deal, the tariffs come off, we get a trade deal, and the tariffs stay on. Very different outcomes. We get a Brexit or we get no Brexit, very different outcomes. So when you have this kind of a political event risk with strikingly different scenarios, that's when the skews and the options start to tell us how afraid people are of these things.
Yeah, it's a fascinating paper. You're right. Eric likes to dive into volatility a lot, so he has some interesting findings. Speaking of interesting findings with yourself and Eric, before we wrap up here, I know you guys have a book coming out fairly soon, I should say. Give our listeners a little bit of a tease of what the book's about and what they can expect.
Well, the book's called Economics Gone Astray, and it's actually live. It's out there. You can buy it on the internet. It's all about why economists get everything wrong.
Is it subtitled The Dismal Science, or was that already taken?
It doesn't have a subtitle, and it wouldn't be The Dismal Science. It'd be more like The Incorrect Science. We think economists as a group tend to be too linear thinkers, whereas everything in markets happens with a curve. It's, you can take off, you can come back, but I mean, you can't think like a flat earth or a linear thinking. And I don't know if you remember your statistics 101, but they taught you ordinary least squares. That assumes the world is flat. That stuff doesn't work. And then another thing economists... I'm
still amazed that they beat the Phillips curve into our head.
Yeah,
and the second I graduated, that was blown out of the window as well.
And that's a good example, because another thing economists forget is economists aren't very good at math. So they build models and they make assumptions. And then the model has some interesting conclusion, and they forget all about the assumption. Like Black-Scholes, for instance, the option model that we all use, it assumes that there are never any price breaks. Everything trades continuously. Well, if you have this event risk, it turns out Black-Scholes is not going to work so well, and your delta hedging strategy is going to fail. So you need to always look at your assumptions that you've probably forgotten. The third thing economists do is forget about context. They forget about things that kind of happen slowly, like the regulatory environment is so different today than before the Great Recession. The demographics are so different today than what they were 20 years ago. I mean, we now have an aging boomer population. We have the millennials coming in. There are more boomers retiring than there are millennials coming in. The millennials have more debt. They're going to get married later, buy their house later, have kids later, never buy a car. I mean, it's going to be a very different economy, and these things are really important to understand. And economists are so focused on my quarterly forecast or my monthly forecast that they forget the whole context has changed. So anyway, those are the three mistakes, and we have about 15 case studies from everything about why there's no inflation to what's going on in demographics and regulatory authority. It's a neat way of just looking at economics. And by the way, no equations. Oh. No equations at all.
It's not an economics book if I don't have to do some integrals or something along those lines.
You don't have to do anything. It's very easy read. So, we're very happy to have the book out, but we're also glad it's done.
That's what every author comes out and says the same thing. I'm happy to have done it. I'm very happy that it's behind me. Give us the title again so our listeners can find it on their bookstore of choice.
Economics Gone Astray.
Economics Gone Astray. I like that. So, Blue, we've talked FX, we've talked rates, we've talked easing, we've talked skew in FX,
yes.
We've talked the book, we've talked a lot of different things. But I know when you come on, Blue, because you always leave us with an interesting hint, a little bit interesting tease of what you guys are working on over there on the research team. So before we go, leave our listeners a little bit of a peek of what they can expect from you guys coming down the pike.
Well, coming sometime in the fall, we're going to release a whole bunch of research on risk analysis, trying to figure out from people's activity in the market, volumes, intraday activity, prices, to like, what are the perceptions of risk? Because we think just looking at implied volatility and the way most people look at it it's not enough. That you don't capture the risk in the tails, and the risk in the tails is what bites you. So we have a whole bunch of interesting risk analysis, and we're categorizing risk in 4 states or perceptions. You're too complacent, you're balanced, which has happened 75% of the time and tells you nothing. You're anxious, and that's a wall of worry. And then you're bipolar. That only happens 2% of the time, but that's when this event risk kicks in, and you're worried about, wow, it could do this, or it could do something strikingly different, but it's not going to stay here. And when you see the super anxious or the bipolar, it's a different risk management strategy than complacent, because complacent has issues too, because you're probably too complacent. So we're trying to categorize risk and then look at how it impacts markets and so forth. But it's a very different approach than just the implied volatility and standard deviations and things like that. So it's going to be fascinating, and we'll come back on in September and tell you all about it.
I'm looking forward. You know where our studio is? Blue, it's not too far from CME. I'm glad we can get you back on, Blue. I'm looking forward to seeing, I have to read the book myself, so I'm looking forward to reading the book and to hearing more about this research coming down the pike.
Thank you.
Great, thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.